Hey, this is James Pelton here on Tuesday afternoon, November the 15th, with Kolin, decade investor, good friend of mine. And I'm excited to talk about it. This is an area. So, a lot of times I have guests on who I feel like I know as much as they do about what we're talking about. But this is something where he knows we're going to be talking about covered calls today. Okay. And to be totally honest, I mean, I understand like puts and things like that and options trading and things like that. To be honest, I don't even know what a covered call is exactly. So that's what we're going to be looking at today. Colin he's younger than me, but we have similar goals, and that's passive income, right? And that's one of his big things. That's one of my big things, and that's why we've gotten along so well. So as we get started, please hit the like button to make sure as many people see this as possible. That's the first thing. If you have questions for Colin as we're going, feel free to ask those and we'll kind of bring them up. If you want him to talk about other things, that's fine too. We'd love to bring, we can talk about that as well. We got Funny Turo here. Welcome. Glad you could join us. Jason says getting out of crypto and going back to stocks. So I think that we'll talk a little bit about that, but I think that is a lot of people are getting burned out by crypto, which is the sign of true capitulation, right? Is when people get out. And I feel like we're getting close there, although I felt like we were getting close there in like July also. So who knows what's going on. But anyways, Colin, welcome to the channel. Could you start quick introduction and then we'll jump right into things.
Yeah. So I'm a little bit younger than James, slightly, but we do live close in proximity. So we get to enjoy the similar weather pattern. So it's snowing where we both are. Yeah, so my name is Colin. I go by Decade Investor on YouTube. I also have a Twitter account and Instagram. Twitter's like where I mainly post. I just crossed over 100,000 followers recently, so kind of celebrating that. But more importantly, James, asked me to come on here and chat about covered calls. I'll also talk about puts, but cash secure puts, so a little bit different as well. But basically, this is a strategy that I deploy with a percentage of my portfolio where I sell options on stocks that I already own, which generates me cash flow to my portfolio. And actually, as a matter of fact, Jason, you can do this on crypto. You can do this on crypto holdings like Bitcoin, Ethereum, I believe Solana on some protocols, Avalanche, and otherwise. I'm going to be focusing just on the stock side of things, but the process of selling options, the covered calls, cash secure puts, is similar. It's just the underlying asset is different, and obviously how you go about it. But yeah, I've been selling options for over a year now, and have seen the ups and downs. Talked to a lot of people that have been selling options for decades. So while my personal expertise isn't like 20 years, but I've been talking to people and learning from people that have been doing it for a long, long time. So really enjoy this strategy to deploy to my portfolio, bring income, and that's what both James and I like is the income, the cash flow. It is not 100% passive. I know there's always that question. You do have to click a few buttons and do a little bit of research. I know, so you don't have to enjoy that, but it is pretty passive and in a sense, but more importantly, it's a way to generate cash flow on your holdings. So I'm excited to chat about that.
Okay, awesome. And maybe virtual assistants could do it for me, so I don't have to necessarily do it.
Yeah, there you go. You just tell them what to click and then you're good.
There you go. Okay, so let's start with stocks. Like you said, I would like to know, kind of what does this look like with crypto? Maybe we can talk about that. But I think the three questions before we get into it is, first off, how much capital do you need to do this? Like, can you start with $100 or what's the kind of minimum capital to get going with this?
Yeah, so the minimal capital needed to sell options is in stocks is the equivalent of 100 shares of a stock. So the answer is it depends, like a lot of things when it comes to investing, but it depends on what the underlying stock is priced at. So for example, if you're looking at Tesla stock, which is about $190 a share, $195 a share, well, 100 shares of that is going to cost you $19,000, which is a lot for a lot of people. Now, if you look at like a cheaper stock like SoFi, SOFI stock, right? It's a $5.92 stock that 100 shares would cost you just under $600. So the cost of, I guess, the barrier to entry is owning 100 shares or the equivalent of 100 shares, which I'll explain kind of why I make that caveat there. So it really just depends. It could be anywhere from $500, $600 north of $20,000. And everything is relation in like how much you're going to get. So Tesla is going to pay a little bit more in income than SoFi because you're putting up more capital. But it is required 100 shares or the equivalent of 100 shares of a stock.
Okay, and you might talk about this, so I might be stealing your thunder or getting my horse ahead of my cart or something. But does it matter? I mean, can you do like a super cheap stock? I mean, I know there's sub-dollar stocks. Can you do one of those, or are there specific stocks that are going to work a lot better for this strategy?
Yeah, I mean the answer to that is I guess, and I'll kind of talk about it too, but I'll get a little brief into it. Is like the risk of this, because when I talk about it at first, it's going to be like, well, where's the risk in this? Because it's out, but I'm not like saying that there is zero risk. There's always risk in this, but the risk is what that underlying stock does. And so, for example, a penny stock. Okay, great. Let me, it only cost me $1 to get 100 shares of this. Well, options are probably not going to be available on that because it's so cheap. But also, B, the underlying stock is where the risk lies in selling options or the underlying asset. And so, if you're buying a crap stock and it goes down and it goes bankrupt while you're in it, well, then you've lost your capital. And so, yes, you can sell on cheaper stocks, but it's more or less finding, if it's a cheap stock, making sure it's a solid stock, a good company that you actually want to, possibly own shares into. And I'll kind of dive into the risks later on in a second.
Yeah. And some of these questions might be answered when I know what it is that you're talking about also. So some of them might be premature questions. One other thing before we get going, what type of returns can people expect? Because again, we're in crypto. If we're getting below 50% APR, not worth it. But I know when you get out of crypto, real estate, I can expect 12%. What are you looking at with these covered calls?
Yeah, I mean, I don't really like to extrapolate to a year because, as we know in crypto, I'm also been in the DeFi space and crypto space, so I know like, hey, 35,000 APY, and then the project fails in a month, so like it's not 35,000. So I definitely I don't like to extrapolate out. I try to shoot for, and I go a little bit more aggressive on my options that I sell on. So anything like around 1 to 1.5% a week is kind of what I like to get. You can be a little bit more conservative and go, 0.25% or 0.5% a week. And again, I don't like to extrapolate and say like that's going to get you 48% a year because a lot of things can happen in that year time frame. But I like to try to aim for that around 1% a week on my money is kind of where I feel comfortable and confident with where I'm choosing my strike prices, in which if you hear me say that, and you're like, what are you talking about? I'll explain it. Choosing my strike price and all that stuff, I try to go around that 1% a week.
Okay. No, I do understand strike prices. So I,
Okay.
From venture cap, like when we have a warrant deal where you get some kind of equity, there's usually a strike price for that warrant and things. So I'm excited to hear about this. One last question before we start.
Okay.
What was it? I think it was a good one. It was something about the risks. Oh, yes. So you come from the crypto world. And so how would you compare this risk-wise to like the DeFi world? Again, I'm just trying to get a sense of the, risk-reward ratio. And where do you kind of see this on that scale?
So the risk for me is basically, or the risk of this is like with DeFi, right? You're putting, I don't want to say any projects names, but let's just say you're putting your money into a project and it's going to give you 1 token a day, 1% a day, etc. on your money. Well, the risk there is like, well, if the token price goes to 0 or it doesn't go up, I'm getting my token back, but I'm getting my 1 token back a day, but my token's worth less. So my capital is getting drained or losing value. And then so for me, the risk of these covered calls or the selling options is, what is that underlying stock doing? Is that, like, for example, if I'm selling options on Tesla, like I do, if Tesla goes to 0, well, then obviously I'm losing my capital, but at least I know I'm investing into a actual company that's like paying, Tesla's creating vehicles, selling cars, etc. So the risk there is like all based in that underlying stock. Andre, take care.
Yeah. Did you know this about yourself, that you only make money from subscribers, not actual projects?
I have created 0 projects in my entire life. Do you know that? 0 DeFi projects, 0. But yeah, the risk there, the risk is like, it's like your stock, you're investing into VOO, which is S&P 500. You're investing into Tesla, to Apple, to Amazon, all these stocks you can sell options on. The risk is like that stock or that company itself going bankrupt, which is not saying it's not possible, but Apple going bankrupt is a lot less likely than a DeFi project, rugging, right? So that's kind of where that risk reward is. So yeah, you're sacrificing percent returns, of course, from like going into like actual stocks versus DeFi, but your risk is depending on the stock is way minimized.
Okay, and sorry, one more. I know I said that was my last.
No, it's good.
but one more. So how does the risk compare to just like investing in a dividend stock or something like that? Because the risk seems the same there. Like if Tesla goes down or it goes out of business. So how do you compare the risk of these covered calls that are getting a lot more than the dividends that you get? How do you compare that?
Yeah, I mean the risk is like if you're a buy and hold investor, right? So like if James, for example, buys let's say Apple stock and just buys it and holds it and collects the dividend, which is roughly a 1% a year, and then I sell options on Apple stock, right? The risk is that if I'm selling calls on my Apple stock, and let's say, and I'll kind of explain it in a second or when I get into it, but like when I'm selling calls on a stock, if that stock goes above my strike price, you as the buy and hold, you're seeing all those gains. You don't have to sell your shares. You're just going to keep getting the dividends, getting the up and down of Apple. If I'm selling a call, depending on what strike price I'm choosing, I might have to be contractually obligated to sell my shares. And by doing that, then I'm losing out on potential gains. So I might just be in a worse position in terms of potential gains. But the reason I say but with that is because, as we know, like stocks and crypto go up, down, up, down. So there's ways you can still, make more than a buy and hold investor or do it better. But it's just buy and hold is a lot less risky because you don't have to like risk, what do I choose to sell it at, whatever. And it's again, the passiveness is with buy and hold, you just buy it and do nothing and just collect the dividend every single year.
Gotcha. Okay. So it's kind of impermanent loss a little bit. Let me just be quiet now. And I'm getting a notebook and and a pen, old school, and just explain to us what you're doing here and how we can make some money off of it. Look at this. I
got a whiteboard. This is the easiest way to explain all this stuff. It's the easiest way to explain.
I love this.
Okay, so basically the marker. Okay. So there's, like I said, there's like the covered calls and there's the cash secured puts side of things, right? And basically, I'm going to talk about the covered calls here. Okay, so with the covered calls, basically how this works, or the process behind this and the strategy behind all this is essentially saying you own 100 shares of a stock, right? And this could be Tesla, this could be Amazon, this could be Apple, this could be, really any stock, any 100 shares. What's up, Malone? I feel like I'm running my morning streams already because I'm the only one on screen. But so it's all good. You own 100 shares of a stock, right? So you got 100 shares of a stock, and then what this is doing is when most people hear options, they hear the buying options. So they see the guy in the Lamborghini on their YouTube ad saying, "I just turned, I did a call on Apple. I turned this $35 into $350, and boom, right?" But the best way to think about it is when you're buying options, you are we got some music going.
I want to help people focus,
Yeah, I like it. Get into the zone. When you're selling options, actually, let me say it this way. When you're buying options, you are playing at the casino. So, for example, if you guys are avid followers of James, when he bought the scratch tickets, he was playing at the casino, right? He was buying options. The selling options, the person who sells the option is the casino themselves, right? So you have the edge, mathematically speaking. So with the covered call, you already own 100 shares of a stock. So again, Apple, Amazon, Tesla, etc. And then what you do is you sell a call on those shares. Okay. So most people, when they hear call, they think buying calls, but in this case, you're selling calls. And because you're selling calls, you are getting paid the premium. So if you look at like in options here, I'll pull it up here on my screen to kind of walk through it.
Yeah, I think you can share screen if you want to. Or you can send me the link and I can do it.
I should be. Yeah, I can. Can you see that?
Yes, let me add it here. Boom.
Okay. So basically, this is like what an options chain is. And this is just Robinhood. Robinhood's really easy user interface. You can do this on Fidelity, a lot of other platforms. But basically, you want to go to like sell call. So when most people hear buying calls or calls, they think of the buying calls. This is selling calls. And then this little stuff here, all these numbers, well, these numbers are bid price. These are the contract prices. So you see there, it shows like $3.15, $3.16, $2.70, etc. And basically, this is the cost of doing business. So if I go in here and the price of QQQ is currently $289.80, $289.90. Obviously, market's open, so it fluctuates. Let's say I want to sell a call at the $298 strike. This $1.13, 1.13. So let me just write this down. 1.13. This is the price of that contract to do business to sell that call. And this is in the contracts or options are in 100 share values. So it's 113 times 100 or $113 is what you're going to get paid to sell that call. So 113 is the total dollar amount. Now, what I just mentioned there, 298 was the strike price. Basically, what that means, sorry, the spelling is horrible. Strike price. Basically, what that means is I'm agreeing to sell 100 shares, and the lighting is not great right there. I'm agreeing to sell 100 shares of QQQ at $298. And the current price was $289.80, right? So I spent, and that's times 100 shares, so $28,900 roughly. And you're saying I'm okay selling 100 shares at $298 if it gets up there. And because I'm contractually saying, hey, 1 week from now, I'm selling my 100 shares at 298 strike. You're going to pay me as the buyer to make that contract. You're going to pay me $113. And no matter what the outcome is, I'm going to get my $113. It's yours. James can take his wife to dinner at $113. Get a really good dinner where you're located up there, huh? So yeah.
Taco Bell. You can get a lot at Taco Bell for $113.
Yeah, big Taco Bell party pack. But basically what it is you own the 100 shares, okay? And then you're choosing a strike price. If I go back to my options chain here, you're choosing a strike price that is above the current share price. So right now, obviously, share price is floating or moving, so 290. But let's say the 298, right? So you're saying I'm willing to sell my 100 shares of QQQ at $298 per share. And obviously, these contract prices fluctuate. So now it's $123 for doing so. So not only are you going to collect your $123 in this case, right? You get $123 in premium, $123. But you also, so here we go. Here's the outcomes. The outcomes of this trade is this. By November 21st, this is expiration. So this is basically when that contract becomes void. After November 21st, it is over, right? The contract is no more. So basically, the best way to think of it is like this. I'll give you an example, and I'll kind of float with this example the entire way through. So let's say I have a trailer, and James wants to buy the trailer from me. He just got some horses. He wants to travel around with his horses. Okay. So I have the trailer. James wants to buy the trailer. James says, I'm willing to buy that trailer from you, right? But I don't know if I want to buy it now. I want to wait a week from now. And I'm like, okay, let's agree on the price of the trailer is 10% higher from where we would go today because you want to wait an extra week. So I'm going to charge you 10% more a week from now. And because I'm willing to hold the trailer for you for 1 week, you're going to pay me a little bit of money. In this case, that little bit of money is these contract prices. And no matter if James buys a trailer or not, I get to keep that. It's basically like when you're buying a house and you're buying a car or whatever, and you say, hey, hold the car for me. Here's the deposit, and it's non-refundable. That's what this is. So me as the seller, I get to keep that. It's non-refundable to James. He has to pay that, right? And then we get a week from now. Let's say that the trailer price does not go 10% higher, and James is like, you know what? I don't want to buy the trailer. So what I'm visually there is saying it's the share price stays below 298. So let's say November 21st, it closes at $2.95. James does not want to buy that trailer. The buyer does not want to buy my shares at $2.98, because if you think about it, why would the buyer spend $298 per share when they can buy it for $2.95, right, at the market? It just doesn't make any sense. So that contract is going to what is called expire worthless. What that outcome is I get to get back my 100 shares, plus obviously the contract prices are moving, but let's say I get to keep my $123. So at the end of the week, I have my 100 shares, plus I pocketed $123 on that money, right?
Okay. Can I ask a couple questions just to make sure I'm getting it?
Yes.
First off, can you change the length of the contract? And is it going to be cheaper the sooner you do it?
Yes. So the closer in time, so November 21st is, basically a week from today. If we did like today, this is today, see how these, you can't even trade them now because of market. Let's go to Wednesday. This is tomorrow. So that $2.98 is only going to pay you 12 cents or $12 versus $123 for next week, if that makes sense.
Yeah, because the odds of it getting up there are very low. So nobody's willing to pay a lot of money for that.
Right. And then if we go further out in time, so let's say like December 9th, we go to $2.95 or $2.98, they're going to pay $450 versus $123. But like you said, that gives the buyers, and we're the sellers, but that gives the buyers more time for that share price to get to $2.98, almost a month versus only 1 week.
Yeah, and if it's up at like 360, then because you're required to sell that to them if they want it, right? If you do this contract.
Well, and this is where it kind of gets confusing. And like, I know we only have an hour, but you can buy back your contract.
Oh, okay.
So you don't necessarily have to sell your 100 shares. Now, you might end up paying more to buy back your contract than you took in income that week, depending on where the share price is. But you're contractually obligated, but there is a way out of it, which is, a whole different kind of math equation and everything. But there is a way out of it. But at a base level, yes, you're contractually obligated to.
Okay. And then, so do you want it to hit the strike price, or would you prefer it just stay where it is? Or what do you as the option seller want?
So as an option seller on a covered call, the ideal outcome is, let me go back to because I like to sell every single week because that's the best that I've found work. So let's say I choose that $2.98, right? The best outcome for me is the share price stays below $2.98, but hangs around, let's say like the $2.90, $2.93 area. Like I don't want it to go above my strike price, but I want it to be kind of close to it. So the answer, like the worst outcome, I guess it's not even like worst outcome, but the not ideal outcome is it goes above $2.98, because if it goes above $2.98, let's just show like the other outcome. If it goes to $3.02, then I have to sell at $2.98. That's the contract. Now I can buy back, but like I mentioned, I'm probably going to end up paying more because this contract price is going to go up in value, very valuable. But that outcome means I could have sold at $3.02 at market, but now I have to sell at $2.98 because of that contract.
Gotcha. So maybe ideal is, like 1 cent below strike price. You get maximum profit on your stock, but you still don't have to sell.
Exactly.
Like ideal.
James, you got it on the T right there. That's exactly like the most ideal outcome. Yes.
Okay. And then if the price goes way down, it just hurts you because they don't have to buy, and it's just hurts you because your stock went down, just like a normal holder.
Yeah.
Right.
So that's kind of what I was talking about, like the risk of the covered call is like that risk is like, hey, that, underlying stock, let's say QQQ, or let's go, like, because you're crypto, and I know this is a pretty volatile stock, but not this Coinbase, right? Like, let's say you buy Coinbase, you buy 100 shares, it costs you $5,500, and you sell a covered call at the $60 strike or $63 strike. But let's say Coinbase tomorrow, you sell it today, and tomorrow Coinbase goes to zero because they come out and have exposure to FTX. Not saying they do, but let's just say hypothetically, right? Then you're in a bad position because you spent $5,500 to buy 100 shares of Coinbase, and then it goes down to $0 and goes bankrupt. So that's kind of that risk there. But not to make it a consolation prize, but if you're selling a call on Coinbase, like let's say back to that, the you versus me, or like the comparison. So if you bought and hold Coinbase and I sold a covered call on Coinbase, mathematically speaking, I'm a little bit better in a position because I collected that $123 and you didn't. Obviously, we're both at zero because it went bankrupt, but I got a little bit of money. You know what I mean? But like, again, at that point, it doesn't matter. You lost 5,500. But yeah, you are, that's the risk of covered calls, is that underlying asset losing a ton of value because you do own the 100 shares of that stock.
Yeah. So that's just the same as holding a stock, the same type of risks.
Right.
Okay.
You're capping your upside though. You know what I'm saying? Like, cause I'll explain that's the other risk. It's not as risky because like you can still profit, but you're just capping that profit.
Okay. Yep. That makes a lot of sense. I do want to get to a couple questions from the audience too as we're going here. Because I'd like to know, so how do you choose what stocks you use? Is it the same way we buy stocks, which is like what I generally do is if there's a product I use, I'm like, oh, if I use it, other people want to use it. That's a good stock to get into. So if I, whatever company made this water bottle, I might go Pogo. They're probably not publicly traded, but you get what I'm saying.
Right.
So let's just talk about that. Then I'll get to some audience questions. But how do you choose which stocks that you personally are doing this with?
Yeah. So like with options, like I was explaining, there is a possibility that you have to sell your shares, right? Depending on where that share price goes, if it's above your strike price, you might have to sell your shares, right? You're contractually obligated to. So I never sell options on stocks or ETFs that I don't want to sell. So for example, I'm a VOO Maxi, the S&P 500. I love it. I buy it a lot. To me, I never want to even run the risk of having to sell that VOO. So for me, I am just simply buying and holding that. Now there's other stocks like Tesla, for example. Tesla is volatile. It's choppy, which is opportunity. But also too, I'm okay owning the shares. Like I'm glad I own 100 shares of Tesla. Like I own shares of Tesla. But I also am not like opposed to selling Tesla because I will just get back in and sell options on it again if I got my shares called away. But with like something like VOO, I just want to buy it and hold it. I don't want to even run the risk. So to me, I ask myself the question, like if I own 100 shares of this stock or if I own shares in this company, do I even want to run the risk of selling that option? Yes or no? Or selling those shares, yes or no? If the answer is no, then I'll just buy it and hold it. But if it's like, you know what, I'm not like married to the stock necessarily, then that could be not like it's 100% yeah, always sell options, but it's just like definitely a possibility of stocks that I'm willing to sell options on.
Okay. Do you have a list of stocks that would be recommended for covered calls?
I mean, less volatile stocks are going to be your bigger stocks. So like your Amazons, like it's all based volatility of like this is all based off of the beta of the stock. So like how much is it correlated to the market? So if it's a low beta stock, so for example, the S&P 500, the market is a beta of 1. Anything above 1 means it moves a little bit more risky than the stock. So a beta of 2 basically means, hypothetically speaking, if the market goes up 1%, this stock will go up 2%. It's like a 2x volatile. So the less volatile stocks are going to be like your more mature companies, like not your Tesla, your Amazons. You're going to be like your Waste Managements, your Walmarts, your Targets, stuff like that. Your less volatile stocks are going to be your bigger names, not really tech, more consumer discretionary consumer defensive, like your Costco's, Waste Managements, Targets, etc. Ford, stuff like that's going to be your more less volatile. Now with the volatility side of things, the less volatile the stock, the less you're going to get, the less buyers are willing to pay for those contracts. And so you have to be like, just like with crypto, right? Like the more volatile something is, they're probably going to pay a little bit more. It's a little bit more risky because it's more volatile. So just keep that in mind, like less volatility, the premiums that they're willing to pay or buyers are willing to pay definitely shifts to the more volatile stocks, because as the buyers of the options of the covered calls, they want it to go above the strike price. Like that's good for them. They want it to go up. And so that is why they're willing to pay a little bit more for those versus maybe like a Ford, where Ford's not going to move. Highly unlikely that Ford moves like, 10% or 12% in a week, where like Tesla could do like 5 or 6% in a day, So the volatility comes with the pros and cons of what buyers are willing to pay for that.
Okay. Nope. That makes a lot of sense. Okay. Audience questions. Do covered calls require a margin account?
No, you can do it on cash accounts. Yep.
And Colin, are you self-taught by making mistakes, or did you go through an options course, or how did you learn about that?
So I went through a mini course, but it was more of like talking to one person who did it, and then he was like, just do this little stock. It was like an $8 stock or $7 stock. I put $700 in Robinhood. I just tried it out, and a lot of it was just like learning by mistake and like trying to figure out, like, okay, when I choose this strike price, so far out of the money, what does that mean? How does that move and stuff like that? So it was obviously learning from someone that kind of guided me how to get there. I paid for, his course and his time. And then from there, it's just continually refining my strategy to find like what works best for me, what doesn't work best for me, what stocks I like, what stocks I don't like. So I guess long story long, it was a mixture of both.
Okay. Gotcha. Let's see. Funny Churro says I like to do options on the S&P 500, so I'm doing other ETFs. So you mentioned you don't do that, but just because you want to keep those, right? Like those are part of other financial goals that you have, correct? But those might be good for somebody to do calls on.
Yeah, I mean, I would like, for example, I'm sure Funny Toro price sells on SPY, which is another S&P 500 ETF. And yeah, you're completely right. You're definitely going to see less volatility with like S&P than you are with like an individual stock like Riot, right, or Mara, which are like Bitcoin mining stocks. And so yeah, you're going to see less volatility with those. And QQQ is probably something he sells on too, or hypothetically. So yeah, to me, it's just my strategy with VOO is just buy it and hold it. But that's definitely an option as well if you want to sell on like SPY.
That's an option.
See what you did there.
Little pun there. Elliot says horses, trailers, Taco Bell. This wasn't in the course, so we got some extra content here. I don't trust Robinhood. Any other good alternatives?
Yeah, I mean you can sell options on a lot of platforms. Fidelity, which I've sold on Fidelity. It's not the greatest like user interface, but you can definitely do that. You can do it on TD Ameritrade, I believe. You can do it on Webull. So a lot of places or platforms allow you to do it. And just, I guess, find what works best for you. I know you can't do it like on M1 Finance because they're like built for long-term investors. So there's some that you can't, but a lot of them that you can.
Okay. And how is selling options less risky than purchasing options? And he says it seems like they're an equal gamble.
So I mean, with the purchasing options or the buying options of things, like you're basically your capital upfront needed is way less because when you're buying options, all you have to do is pay for the cost of that contract. Versus when you're selling options, you have to have the 100 shares, which is probably it can be way more than what the contract costs. The thing there is that when you're purchasing options, you are basically betting, for lack of better terms, is that stock going to go, like if you're buying a call, it has to go, like you want it to go up, because if it goes down, right, you're going to be losing money, and you're not, you might going to lose as much money in the sense of like, let's say you, like on that contract example, it was $123. So you spend $123 on a QQQ call, it goes down, you might sell it for $100. So you lost $23, right? But you're basically just betting, hey, is it going to go up? Is it going to go down? And like it has to go up or you don't make money. And when you're purchasing options, they're not to get like down into the woods of or deep into the woods of it, but there's one of the Greeks of options is theta, which is time decay. And so when you're buying options, time is against you. When you're selling options, time is for you. Like as you get closer to expiration, that's good for you. So there's like alternative risks other than just like the cost of getting into it that make buying options. You can make way more money. Like I don't want to overlook or like glaze over the fact that when you're buying options, you can make a lot of money. You can turn a little bit of money into a lot of money, but you're taking on a lot of risk and things are against you. Versus when you're selling options, it's not like the flashy. You can't, I can't turn 10,000 into 100,000 on 3 trades. That's just not going to happen. But over the long term, mathematically speaking, odds are in your favor. And if you have that type of capital, it's a way more viable long-term strategy than buying options.
Okay. Nope. That makes sense to me. Let's see. Next question. Selling options regularly can add yield to your account. The problem with selling covered calls is you have limited upside, but exposed to unlimited downside. So my understanding would be that's why you're picking solid stocks, where the downside is probably not the risk of it going way down is not super, super high, although we think that with a lot of things. But
Right.
am I right about that?
Yeah, you're completely right. I mean, that's where, like, if you go like an options chain and you go and you like build a covered call, it's going to say downside or maximum loss unlimited, or downside unlimited. And like that's obviously a scary thing, because you're like, whoa, like I just spent $5,000 to buy this 100 shares of the stock, and now it's unlimited downside. Like, what the heck? That's scary. The downside of covered calls, in terms of like what they're saying is if QQQ, if Apple, you sell a covered call, and if Apple goes bankrupt during that contract, from 1 week from now, from the expiration is during that, if it goes to zero, that's your downside. So that's why, James just mentioned that, and we talked about it earlier, is like, it's important to sell options on stocks that like aren't crap stocks, basically, in a PG word, aren't crap stocks. And then also B, you actually like believe in that company. Just buying into it because, it pays a good premium, that's great. But if it goes from $100 to $30 to $10, well, you just spent, $10,000, and now your 10,000 is worth 1,000. Like, yeah, you made some income, but your capital is $9,000 less. So yes, the downside is unlimited, but you can kind of, I don't want to say anything's possible.
Yeah.
I'm not like trying to say it's not possible, but when you're selling on good companies or good stocks or good ETFs, that downside, that downside potential is a lot less risky than like some random stock, like, that you just don't know about because it pays good premiums.
Right. It's kind of like when you put into your if you have an IRA or something, or 401k with your company, I mean, that's got stock market exposure. So technically the downside is unlimited. You could lose everything that's in your retirement account.
Right.
But just when you look at the history of the stock market, that's not the way that it's worked. So you would be pretty confident that you're not going to lose all of your retirement fund. Although these days, maybe we're not as confident as we once were.
Yeah. Well, and that's where like, selling on, earlier, I can't remember who it was, Funny Toro, I think, like selling on S&P 500, right? He's selling on an S&P 500 ETF where it's like, hey, if S&P 500 fails, then like, I don't know what we're going to do. Like, world's ending, because that means like 500 largest companies in the United States fail. So there's obviously, I don't want to like glaze and say that nothing's risk-free. I like to make that point clear. There is risks with this, but you can mitigate your risk or minimize your risk by selling on stocks that or ETFs that have less potential, right? Potential is kind of means, various things, but less potential than like some other, risky stocks.
Okay, gotcha. And then we talked a little bit about this, how much initial is needed, how much percentage return can be assumed. So we talked about this at the beginning, Arvin, so you can watch the replay, but basically you just need 100 shares of a stock. So it depends which stock you end up choosing. Like for Amazon, you're going to need $10,000 to get 100 shares of Amazon. So it just depends which stock you want. And then Kolin shoots for 1% a week is what he's aiming for as his return, but that's obviously going to vary. And then your stock prices are going to vary. So you might have made 1%, but then the markets, you might have lost 0.5%. There's a lot that goes into calculating that.
Yeah. And like the reason I say, there's a whole different side of this ball game called cash secure puts, which we didn't even touch base on, but there's a whole different side of things where you can get into a stock. Like, for example, Amazon is trading at,
was $99.40.
$99.40. So you could say, hey, Amazon's at $99.40. I don't have $10,000, but I have $9,800 or $9,700. So I can sell a put on Tesla or on Amazon. Say I'd be willing to buy 100 shares at $97 strike. So if it goes to 97, I could buy 100 shares. So I get a little bit cheaper, and I'm collecting premium on that way. So not to like make this whole thing more confusing, because I know we're on time constraint, but there's a whole different side of the ball game too, that you can make money and also get shares for cheaper than where they are right now.
Okay, this is awesome. I'm learning a ton, man. Whoa, wrong view. I don't like that one. You can see too many flaws on my face.
Yeah, I know you can see my hairline,
Yeah, exactly. I have this weird tan line going on with my hair, like when I get it cut.
Yeah.
Anyways, let's do the next question. Docky says, can you ask DI how his Flux is doing?
Next question.
Yeah, we'll go to the next one. I have Flux now too, so I'm gonna.
I don't have any Flux. I don't have any Flux.
Okay.
Don't tell Andy. Don't tell Andy.
And I do not know what a covered put credit spread is. But why do you choose to sell covered calls as opposed to put credit spreads?
So yeah, I mean there's different strategies you can deploy. You can do iron condors. You can do some butterfly something or another. There's always different things that you can do. I just like to keep it simple with doing covered calls and cash gear puts because I have the capital to do so. And I know that. So I know that there's a lot of people that maybe don't have the capital. I'm just not well versed on because I don't spend any time doing credit spreads or iron condors or anything like that. So I'm just not well versed on that, Greg. So really good question. I'm not someone who talks on things I don't know, and I stick to what I know. So I wish I could give you an answer, but since I'm in a position where, and I understand I'm in a position where I have capital to do that, that's where I spend my time. But if you send me that question on like Twitter or something, I'll get you connected with someone who knows the answer. But I just don't spend my time there, and I don't like to talk on things I don't know.
Yeah, no, that's awesome. And that's one thing I've learned about stocks is that like there's so many different strategies. Like there's so many different things that you can do. You kind of think it's just simple from the outside. You're like, oh, just buy and sell when it gets higher. But there's like you said, yeah, covered calls, bull call spreads, credit spread. Like there's just so many different things that you can do. And what I always talk about too is you can dip your toes in and then you can slowly get into deeper things. So like covered calls might be, somebody who's watching their first exposure, and then go learn about bull call spreads and things like that. And the only reason I know what a bull call spread is because I Googled put credit. This is how I learn everything that I know pretty much.
Yeah.
I
mean, there's like, just to give you an idea of like everything you can do. So you have like the cash gear put covered call, but then you have like straddles, strangles, butterflies, condors, ladders, broken wings, back spreads, synthetic longs, synthetic futures, synthetic puts, ladders. There's all these things you can do. I think I sit in the camp of like, hey, if I find something I know and I understand and I'm really good at it and I find what success with it, I'm just going to stick with it to keep it simple. Because it can get really confusing and sometimes the basic things you can find success and do really well at. Sometimes it doesn't have to be this very strong, long, complex thing.
Okay. And then let's see. Okay. Scott says, what do you do if you sell a call option, make a couple % on your holding, but then this underlying security drops by 5? Do you roll the call into a new one? And if so, what basis? How do you handle something like that?
Yeah, really good question, Scott. So, I mean, the short answer without getting way into like everything to, take up our time. But basically, let's say, I'm selling a call and I sell it for the contract's $1. So I collect, $100 selling that. Let's say we get close to expiration, that contract falls down to 5 pennies. I might buy it back because that share, the security dropped by 5%, it goes to 5 cents. Let's say I can buy it back for $5. So basically I collected 100. I spent 5 to buy back that contract, which would then release my 100 shares. So I get my 100 shares back in my thing. They're free of the contract. And then I can turn around and, either this is pretty much rolling it into a new one. And the idea there into a new strike for the following week. The idea there is basically, mathematically speaking, it's usually better off to buy back early than letting it expire worthless. Not always the case, but I'm a big math person and math usually says to do that. Now, if the security drops by 5%, obviously the strike price you chose from the week before won't be paying the same premiums because it's now further out of the money. So you do have to change your strike prices probably a little bit closer to the money. And so, at what basis, that just depends on what it would be. Probably 5% less, but it all depends on a few different factors. But really, rolling into a new one, or I like to buy back and then resell and just keep it flowing every single week. Because that's where, I found success in my options strategy is just buying back on Fridays if possible. I collected 100 and I could have got the full 100, but I paid $5 to buy it back. 95 is better than 0. So I'll take my $95 and roll it into the following week and collect another $100 or, not guaranteed 105, 103, 96, whatever it is. And just keep flowing that, week out, just as far as it goes until your shares maybe get called away, whatever. And then there's all these different strategies you can do on that too.
Okay.
But really good question, Scott.
Yeah. No, Scott's got great questions all the time. Scott, appreciate you, man.
That's my dad's name. So, Scott. So he thinks like a Scott. I like it.
Okay. Yeah. I could tell you were a Scott.
Yeah.
So Colin, do you use technical analysis along with your covered call strategy or just mechanical? Basically, how do you pick your strike price? Because again, I could look at what you were looking at on Robinhood, and for me, I would just random, okay, this one looks good. I want to make $10, so I'll
Right.
pick this one. How do you pick your strike price?
Yeah, so there's a couple ways to go about it. Number one is one of the Greeks is called delta, and delta is if you look, and I'll just briefly show it here to make it easy to see. Oh yeah, you can see that. Okay, cool. So like if I'm selling a call, right? So this guy here, so like delta is 0.21, delta is 0.27. So as you get closer to the strike price, or sorry, as you get closer to the share price, so 102 strike is 28 delta, 101 is, which is closer, is 35, 100 is 42, etc. So what I'm looking at there is I like to sell in the delta 0.2 to 0.3 range, which is going to give me a pretty good buffer away from the share price, A, but also B, I'm looking at, I'm more of a macro investor. So I'm looking at what's going on that week in the market and what's, it's kind of forward looking because you're selling for the following week. So you kind of look a week ahead of what's going on. So for example, 2 weeks ago, I knew CPI was coming out last week. So I'm sorry if that time was 2 weeks ago, I knew CPI was coming out the week later. And, I was like, okay, if CPI sees above what is expected, like higher than, I see, the market's not going to be too excited. It's going to go down. But if CPI is less than what is expected, which happened where it was lower than what was expected, we saw the markets go crazy last week. In a week, NASDAQ up 7% in one day, S&P up like 5% one day. So I was like, okay, what's the outcome there? Well, if it goes below, which I was like, there's obviously a pretty high probability they've been really aggressive on the rate hikes, that we might see a lower than expected inflation or CPI, which is going to boost the market, was my prediction. So I gave myself a little bit of a buffer on how far my strike prices were out of the money. And so I was going maybe closer to delta 0.2 or even lower than delta 0.2 to give myself a buffer. Now with that, you're sacrificing premium income, but you're also protecting your shares from getting called away. But also B, if I'm, what is my average cost I paid for those shares? So if Amazon, for example, let's say I bought Amazon for $99 a share, right? So 99, it wouldn't make sense for me to sell the $98 strike because that means I spent $99 per share, but I'm going to sell it for $98 per share. So I'm going to lose $1 per share cost basis on my capital. I want to protect my capital. So if I paid $99 per share, I want to sell at least $99.50 or $100 on my covered call or higher, so that even if my shares get called away, I'm collecting premium, but also my actual capital is increasing in value too. Does that make sense, James? I don't want to, if I talk too much, make sense.
No, that makes really good sense. So can you say again what the delta you look for is ideally?
Yeah, so I'm looking at delta 0.2 to 0.3, which the reason that's the case is because a lot of traders like to define delta as the probability that an option will end up in the money. Now, in the money means, here it's easily visually explained. So in the money is all these strike prices that are below the share price. So in the money, out of the money. Does that make sense? All these ones above are out of the money because they're out of they're above the share price. So a delta of 0.2 is usually best defined as a 20% probability that my strike price will end up in the money, or an 80% probability that it ends up out of the money. As an option seller, we want it out of the money. So that's odds on my side that it's going to end up out of the money, or I don't get my shares called away. Now, that's not the end all be all, but that's kind of where I like the delta 0.2 to 0.3, because over the long term, 80% probability I'm going to win. I will play that game, every time I can.
Okay, awesome. And yes, Scott, Funny Turo, you guys are out of my league in this stock discussion. I don't know what any of you guys are talking about, so maybe you can hop on Discord or hop on Colin's channel and we can talk more about that. I am interested. I do want to learn too. Speaking of learning, so there's obviously a lot that I don't know about this. So you have a training course. Do you want to talk a little bit about the training course and what all is in there? Like, is this something that, if I want to get started, is it, I guess that's why you built the training courses to do that, but you just want to talk a little bit about that and what's in it?
Yeah, so I put together 9 video lessons going over what I briefly talked about today with the covered calls, but also the whole other side of this end, which is cash secure puts. And I put together 9 video lessons going over each different things, my strategies, what to look for, what those delta, that theta, all those Greeks stand for, and kind of how to handle certain situations like Scott and Funny Turo are talking about, like how to handle those kind of situations. And so I put that course together. Over 800 people have taken it. Get a lot of good feedback about, how it's helpful. It's geared for beginners. Like, hey, I'm just now trying to learn this, but also, I talk about some higher level things too. And then everything I continually adding to it. So when I add to it, those people that already got it, they get it all for free. And, I want to make sure that like people learn. So I have it priced at $50. It's very, cheap in relation to it. But I want to do, for James's channel special, if you use the code James at checkout, just his name, JAMES, you get 30% off the course.
Boom.
So it's only $35. And like we've been talking about, depending on the capital, that $35 could be earned back in a week or two, in a month. And then you continually just make more money with it. So that's a course I put together. Like I said, it goes over the covered calls what I briefly explained today and talked about, but also the cash secured puts as well. So James linked it all in the chat. If you type in James when you check out, it will take off 20%.
Okay, and I want to just I want to let you guys know
30%. Sorry, 30%.
30%. I was going to say
yes, 30%. Yeah.
But I wanted to just say this is super cheap for a training course like this, and I'm advising Kolin to raise his prices way higher. Like you guys saw, we did that crypto masterclass yesterday, and that was $297, and he's raising it to $497. So yeah, just be. This is a steal in my opinion. And you got 20% off. I'm not even just saying that to sell it. Like I get some affiliate, but we're gonna have to sell a lot of courses to make money at 5 or 10 or $15 a piece. So
and the reason for it, reason for it is because like, I could probably sell it for more, but I want to make sure, and currently this is where it's currently priced. So could go up in the future. But I want to make sure that, people get into it and understand it. And like, I know a lot of people maybe don't have $300 to pay on a course. So like for now, at least I want to get that information out and get people to learn. And obviously a lot of people, over 800 people have bought it, tried it, learned it. People are doing it. So definitely like is used. But so it probably will go up in the future. But for now, I just want to make sure people get this information. And for it obviously takes time to make it, but that for a nominal price, they can learn how to make hundreds or thousands of dollars every single week.
Yeah, maybe you could do something like $50, then $250 after you make your first 300 or something like that. Work out something like. Anyways, I'm always thinking, am I greedy? I'm always thinking of ways to raise prices on things.
Yeah, I gotta stay away from James. Next thing I know, the course is gonna be $50,000, and then no one's gonna be able to.
Hey, man, don't like what you shared here today. Like, don't undervalue that. Like, that's something I didn't know. I haven't really heard of that. Yeah. And I mean, it's something that you've put in the time to do. So just, don't undervalue. I'm like, thanks for doing this for free for us, really appreciate that. So yeah, go hit up Decade Investor, his course, his YouTube, his Twitter, his Instagram, go follow on all those things.
Yeah. And real quick, Scott, I know he has a few minutes ago his comment, but yeah, you're definitely right, Scott. There's sometimes it's not necessarily bad to sell, and this is getting above James's head, he said, but it's sometimes not bad to sell with less than your purchase price, the strike. Just depending on, like I've done it before on certain stocks, and just understand the risk by doing that, and maybe you have a belief in what it's going to do in that week. They're like, hey, it's going to be a bad week because CPI is going to be bad, so I'm comfortable selling 50 cents less than my average cost or whatever. And always have to factor in the premiums you collected that make your break even maybe different than what your actual average cost is. Sorry, that was a little caveat there.
No, that's good. That's good.
I feel a little bit of homage to him because of my dad's name, so I have to, show,
you do a really good job. A couple compliments for you. Colin's help with targeting ETFs for my pension has been an incredible help. That's reaping rewards.
Love it.
Colin's a good teacher. Selling cash secured puts is a great way to DCA into something you want to accumulate.
Yeah, and that's the other side of the stuff I didn't even talk about today, which is in the course though. But yeah, selling cash secured puts is another great way to dollar cost average into a stock. Like for example, like I was saying, Amazon, it's $99. I want to get it for $95, and by doing that, I can get a little bit of premium and maybe get Amazon for $95 a share, which is really good price if you think it.
Yeah, absolutely. Well, we should schedule another time. You can come on and talk with us about that because I just love learning. Even if I don't end up using it, which I think I am, I'm going to give these covered calls a try. So actually, there's my question. So let's
Yes.
say I buy the course, I go through the course. What's the first things I need to do? I need to download Robinhood because I don't even have a Robinhood account.
Okay.
I mean, I'm old. Like,
You and Andy are the same.
yeah, right. I need to download a Robinhood account, get an account, or download the app, get an account set up, then decide on a stock would be my next thing, or what's going to cause the steps to making this happen?
So yeah, definitely get a brokerage, whether it's Robinhood, Fidelity, or something. I recommend Robinhood. I know that they have their issues with like trust with people, but at the end of the day, they are insured. So your money is insured through the SIPC, which is a whole different conversation. So it's not as bad as you think it is. Your money is safe if you're dealing with small amounts of money, like less than $500,000, small amounts of money. Your money is secured. So yeah, download Robinhood. Obviously, you put money in, and then know and figure out like what type of stock you want to sell options on. Some low price stocks. Like I'm a Bitcoin guy, and so one of the stocks I like to sell options on, which is a very cheap stock, is Riot or Marathon. There's a $6 stock or a $5 stock and like a $9 stock. So $500, $900 can get in. You can learn, and then just kind of play with it and like sell calls and see what happens. Like, oh, I sold a call at strike 10. It went to 10.50 on expiration. What happens? Like what actually happens? And see like, okay, over the weekend, Robinhood will automatically sell my shares for $9 or for $10. On Monday morning, I'll wake up, I'll have $1,000 in cash in my account. I don't have the shares anymore. Okay, now I know what that does. Now let me try to sell a put. Like we were talking about cash secure puts. Let me sell a put. What does that do? How does that process work? What happens if I get assigned those shares? How does all that? And just like, play with a little bit of money and like build that trust. I did it for months with less than $1,000 and just like learned it and understood it so that whenever I figured out how to do it then I started putting more capital into it because I learned to trust what is going on. So yeah, pick like a cheaper stock, $6, $10 stock and try it out and just practice.
Okay. I like that. I'm going to do it. I'm going to download Robinhood, set up an account, choose a stock, and do my first covered call before this weekend. That's my goal. Okay. That's a smart goal. Time
you have my number. So if you have questions, call me. Yes. Call me.
This will be option. This will be awesome. I was trying to say awesome. Option.
You can make up your FTX money. I lost $11 in FTX. I don't know, probably not the same amount as you did, but I did lose $11 in FTX.
Yeah. I lost 12K I had sitting in there. So it could be worse, but it could be better. So it's no yield nodes, but it's a fun thing.
Yeah.
So awesome. Well, we'll go ahead and close up there. Again, calls to action for you guys in the audience. Hit like on the way out. These are free options. Okay. Hit like. It's free. Go follow Decade Investor on Twitter, YouTube, Instagram. That's free. You don't have to pay anything. Buy his course. That costs. So that's a little bit more. And then start doing covered calls and let me know your results. So I'm going to go through the course and then I might do a video just, hey, I did it for 30 days. Here's what I ended up making and see, how a beginner does compared to Kolin, the young veteran.
Yes. Real quick, quarter mile, how much time per week is needed to keep income rolling? I mean, in terms of like, you have to obviously pay attention to the markets and like figure out what's going on, but to like actually make the sale, it takes no more than a few minutes to like choose, hey, like go in there and like sell call, strike, boom. It's more or less just like the news and following it. So yeah, the course kind of explains that stuff. And then secondly, not to like one last little plug here, this is not free, but James and myself are in Sleep Money Club, a Discord where I trade with a couple other people, teachers that will trade, and we kind of break down news and help us like to choose strikes and stuff like that. That's all on my YouTube channel or my Twitter. When you find it, James, I guess just linked it right there. Thanks, James. But yeah, and I stream every single morning on my YouTube channel for free. This is another free option. Every single morning, 5 days a week, and I talk about the stock news and everything, so kind of get your news there. So last little plug there. James, thanks for having me. Appreciate you. Stay warm.
Wait, I have two more things that came.
Two more. Okay, here we go.
This will be short though, because I like to stay under an hour. People freak out if videos go over an hour.
Yes. All right, 30 seconds. 30 seconds.
Have you considered like VAs to do this to make it more passive? Have you thought about that or looked into it?
I'm a little OCD, like I'm a little control freak, so I don't like to give up control. That's
Okay.
yeah.
I see. I don't have that problem. So maybe I'll start exploring that direction. Because if you can get it down to like a formula, like, hey, look for delta 0.2 or 0.3. Here's the stocks. Here's this, I think a VA could probably do just as well as I do. Maybe I put them through the course.
Hey, possible.
Second thing, have you ever talked with any crypto projects about like an NFT that is using this to back it, using covered calls to generate the revenue?
I have not, but I do know you can, and I know we didn't really touch on this, but there are protocols in crypto that allow you to do options on crypto. And so I don't do that, but I know there are. I just blanked out on both their names, but there is what the heck? I can't think of them, but there are two. Oh, Synquote. Synquote is one. SYN quote, like QUOTE, and Lyra, LYRA. Those are two places. I don't want to I don't recommend them. I don't use them. So like, obviously with your own risk, but I know someone who works with them. So yeah, so there's way you can do it in crypto as well. You can deploy these strategies too. And the process is the same. Like if it goes above, you lose your shares. That holds the same. It's just obviously the underlying asset is different.
Do you see any problems like with an NFT that the funds used go to somebody doing covered calls and then like airdropping out the profit? Like basically just using covered calls as a income stream. Because then you wouldn't have to, like, if you don't have enough money for, $10,000 to get into Amazon, if you could combine a few people, have you thought about that, or do you see problems with that, or is that something we should talk about later?
I mean, I'd be down to have that conversation. It's no different than like a trading bot, right? In a sense of like like if you've heard of QYLD, which is an ETF, stock ETF that does covered calls, and you get dividends every single month, which is pretty much the same thing. It's just using traditional versus NFT in the new space. So yeah, there's definitely conversations to be had about that. I think it's really interesting. So maybe that's something, James, we can reconvene on.
Okay. Yeah. Yep. We'll talk about that more. So we'll go ahead and close up. Audience, thank you guys. You guys have been awesome. Kolin, thank you for coming, sharing your knowledge and expertise. And I'm sure we'll be having you back here shortly.
Yeah. Thanks, James, for having me. As always, appreciate it. Take care and be safe.
Yep. Everybody have a great rest of your Tuesday. Thanks.
See ya.